think the most significant development during the week, at least from the perspective of the market, was the weakness in the US dollar. And I talked about that on my last podcast, but the dollar weakened considerably in the 2 days following that podcast. And in fact, the dollar closed about the low of the day on the Wednesday when I recorded that podcast earlier in the day. And again, this was in reaction to the better than expected consumer price index that came out on Wednesday. And we actually got better than expected PPI data as well on Thursday. So that likely helped weaken the dollar. Again, this is all counterintuitive, ironic, that the dollar losing less purchasing power than anticipated means that the dollar loses its purchasing power on international markets. So you would think it'd be the opposite.
In this week's market analysis, renowned economist and financial expert Peter Schiff uncovers a significant development that has caught the attention of investors worldwide: the weakening U.S. dollar. With the dollar index dropping by a substantial 2.3% in just 1 week, this could mark a pivotal moment for international markets. But why is the dollar losing its purchasing power despite better-than-expected economic data? And how does this tie into the ongoing inflation debate? As Peter delves deeper into the numbers, he reveals a fascinating correlation between the dollar's strength and inflation levels. Surprisingly, the dollar's prior strength played a crucial role in curbing inflation, acting as a tightening tool without the Federal Reserve needing to hike rates further. But now, with the dollar on the decline, could this signal a potential easing of monetary conditions? How will this impact commodity prices, particularly oil and silver, which have been gaining momentum in recent times? As the video progresses, Peter provides essential insights into the intricate dance between the dollar, inflation, and commodity markets. But what's the real takeaway here? And how might these developments shape the future of global finance? To uncover the rest of Peter's eye-opening analysis and his predictions for the dollar's future trajectory, don't miss the thrilling conclusion at the end of this video.
But I've explained for many reasons why this is the case. But the PPI was supposed to come out at plus 0.2 for June, and instead it came out at plus 0.1, so better than expected. There was an even bigger improvement in the year-over-year increase, which was supposed to be 0.5, and that was a lot lower than the 1.1 from the prior a month year-over-year. That was revised down to up 0.9, and the June number came out at just 0.1, so barely positive. And even when you strip out the food and energy, the monthly increase was just 0.1 compared to 0.2 estimates. And the year over year was supposed to be 2.8, which would have matched the prior month. And instead it came down to 2.4. So more better than expected data on prices weighing on the dollar on Thursday and then again on Friday. So the dollar index actually dropped by 2.3% on the week. That may not sound like a lot, but when it comes to foreign exchange for a currency like the dollar, that is a big move. Significantly, the dollar index closed below 100. We haven't been at this level since May of 2022. So that's pretty significant. Also, I think psychologically, getting below 100 could be significant. You know, the US dollar rallied starting in January of 2021. That was kind of the low of the dollar. And we rallied from January of 2021 all the way through to September of 2022. That rally was almost 30%, maybe 29%. That is a huge rally. Now, since that peak, the dollar index is now down about 13%. It's still up a lot, but not nearly as much as it was. But what's significant about this is the main reason that the inflation numbers have come down as much as they have. I mean, even though we haven't come anywhere close to 2% on a year-over-year basis, we're a lot lower than we were, thanks in large part to the strength of the dollar. That acted as a tightening all by itself. Yes, you had the Fed raising rates. you had the Fed shrinking its balance sheet, but you also had the dollar going up. That helped the Fed. That was a tightening in and of itself. Monetary conditions tighten when the dollar goes up. And so that helped bring down prices. Think about it from this perspective. Commodity prices are priced in dollars, at least for now. That's how they're quoted. That's how they're traded by and large. And so if the dollar goes up by 30%, those prices go up by 30% for every other country. And so that really results in a reduction in demand because of that huge increase in price. That brings down the price, and that benefits the US because we have dollars. We create dollars. So we don't see a price increase in commodities when the dollar goes up. We actually get a benefit because more of our international competitors who are bidding for those same resources get priced out. Their demand goes down because they're looking at these higher prices. And so then we get the benefit of lower prices. So the dollar, the foreign exchange market, was doing a lot of the Fed's work. It was tightening without the Fed having to hike rates more. And a lot of the strength in the dollar was a byproduct of just rhetoric. The Fed being very tough, all that tough talk about how they were going to keep on fighting and doing whatever it takes to bring down inflation, that got, factored into the dollar. In fact, the dollar started to rally even before the Fed started hiking. It was because the Fed started to indicate that it was going to hike. The foreign currency markets got in front of that and started to discount those rate hikes and that tighter policy, and the dollar started going up. Well, the dollar is now falling because the foreign currency markets are again forward-looking. They know that the Fed is either done hiking or close enough to the peak that the next significant move that the markets are looking for is an ease, and that's being priced in. But the fact that the dollar is already falling, again, that counts as an ease. So even if the Fed continues to hike, if the dollar keeps falling, that effect will be larger than the rate hikes. And so even though the Fed would be hiking rates, the weakness in the dollar will actually be negating those hikes and will have the effect of a cut because it will be loosening monetary conditions. And as I've been saying, the weakness in the dollar is going to result in strength in commodity prices. Oil prices closed at about $75.20 on the week. We were actually down on Friday, but we've been gathering a lot of momentum. Other commodities, silver in particular, has been particularly strong, not just because gold was strong, but silver is also an industrial metal, a commodity in that respect, and it is also moving with the dollar and inflation.
As we reach the end of this captivating exploration into current economic events, I hope you've gained valuable insights into the ever-evolving financial landscape. Remember, staying informed about the latest economic developments is crucial in today's interconnected world. By understanding the forces shaping our economy, you can navigate the uncertainties and seize opportunities that arise. Whether it's market fluctuations, policy changes, or global trends, staying engaged with economic news allows you to make informed decisions that impact your financial well-being. Stay curious, stay informed, and don't forget to like, comment, and share this video.